Kenneth Andrade joins us. Let's take our conversation forward. Let's understand from him what he makes of the current market setup. Kenneth, fantastic to have you back on ET Now. Thank you for joining us.
Morning, Nicholas. Long time, yes.
Yes, long time. In the long time we've not interacted, a lot has changed. Last time when markets were at these levels, crude was at 75, inflation was supposed to be transitory, there was no war, and bond yields were looking reasonable. But the world has changed, and markets are not far away from an all-time high. So what explains this comeback despite odds?
Well, if you just look at the indices itself and deep dive into the profitability of the indices, there has been a leadership change. Okay, commodities, a large part of commodities actually are now contributing to the profitability of the indices. A large part of tech is now contributing to the profitability of the indices. And and our sense remains, and we've been saying this for some time, that in this churn, the indices may not have too much pressure on the downside. It may not have too much pressure on the upside itself, because over a narrow period of time or even a medium period of time, this shift in the leadership will take place, and towards the end of the decade, you will have new components that will lead indices forward. And I think that's what you will see happening. So index will be sticky. You will have these volatility bouts, but the profitability loss of one sector is a gain on the other sector. Someone's gaining on the other sector, and which is why indices are remaining where they are today.
Kenneth, which end of the market do you think will emerge as a winner or a survivor in this entire commodity stroke energy shock?
So if you look at the narrative, and this goes across, and it's probably started before the war that was there in Crimea, in Ukraine, and even a little bit before the COVID crisis, and inflation was particularly sticky at that point in time. Our sense is that this could be the narrative for the rest of the decade. Commodity prices because of the supply shocks, and also because governments want to bring the supply chain home, so that will be a lot of rebuilding of their entire economies. Commodity prices will be high, and it will be managed inflation. So that our sense is the narrative for the better part of this decade, and that will lead the components of the index. I mean, any company that benefits from a scenario like this will effectively lead the indices or lead the marketplace, or will claim leadership for the better part of 2022 to 2030.
Okay. Specifically on commodities, if there is going to be a recession fear, and if central bankers are now in a sense are calling it, now the central bankers are saying the war is not COVID, the war is actually inflation. When you see this kind of an attempted strong strong view by central bankers to bring demand down, what will happen to commodity cycle? Because they say you should never fight the Fed. In this case, the Fed is now fighting inflation, not growth.
So you're right there, and I think when we look at demand, you have to look at two baskets of it all. One is consumer demand is definitely going to drop. Okay, that's going to be replaced by something we haven't seen for a very long period of time, which is government balance sheets. And government balance sheets are now going to start contributing to a demand pickup. So the nature of demand that you will see on the ground is going to be very different from what probably you've seen for the last 10, 12 years. And that's the part that you need to align with. If I go a little bit granular, demand remaining static, okay, or demand remaining where it is, assuming that there's no growth, look at where India's GST collections are going. And this is happening across the globe. This is not happening to India in isolation, but we have India's numbers, and we're very familiar with that. Our GST collections have moved up from 100,000 crores to 140,000 crores. A large part of that is inflationary because prices of all the commodity spaces have gone up. Now, if the government's going to earn 40,000 crores a month, okay, and additionally, you annualize that number, they are going to be one of the larger beneficiaries of the cycle. Okay, so how do you play inflation? How do you characterize inflation, and how do you structure a portfolio into inflation? Look who the biggest earner out of commodity prices is going. Commodity companies and obviously taxes, and they are going to be the next spender of in the cycle. So just align yourself with those cash flows. I think your portfolio will be fairly robust into whatever remains of the decade, which is another 8 years.
Good morning, Kenneth. This is Nantara joining in. So as we wait for the rate cycles and get more clarity, I have a question for you as far as financials go. You've always liked to steer away from financials, but a lot is being now said the next recovery, the next bull run will be with the participation of the financials. Will you change your view when it comes to the sector?
If you go back into the past, we've had markets hitting an all-time high without financials. This was the case in time where market hit an all-time high with financials. So it is very company specific, it is very stock specific, and it's got to do a lot with the macros also. But if I had to put a portfolio in place and I had to look at the lending business necessarily has to come from companies that address corporate spends. Okay, they don't have the great pricing power today because a lot of corporates are fairly solvent. So there are only two large borrowers in the cycle. One is obviously the government of India, and the second large borrower is retail. Okay, and retail also is the bottom end of the structure, is the bottom end of the pyramid. So in the near term, there is no change of view. But once the corporate cycle kicks back again, once we see the lending books or the bank balance sheets start expanding with pricing power, I think that's when we will change our view on that. And also, I think by that time we will get a lot of these companies at fairly attractive valuations.
Okay, so let's see how the financials pan out. We touched a little bit on the tech sector, but just going a little beyond that, talking first day the markets will react to the Infosys numbers. TCS is out. Mindtree is going to be out. If IT was the star performer in 2020, 2021, not leading towards that in 2022, what would make FIs, DIIs, investors believe in IT again? Are they waiting, for example, price hikes?
So I think here the case in IT is effectively a lot of margin pressure that is coming. The outlook in terms of the volume growth that are there are fairly okay. They could normalize, or I think they will step down a little bit in terms of the outlook. But as far as the margins are concerned, we've got to classify them as whether they're structural or whether they're cyclical in nature. My sense is IT will come back again. They need a little bit of price hike. And over the next year and a half, when new contracts come in, you will see most of the pricing taking place out there. So I'm not too worried about IT, at least in the longer term. In the shorter term to medium term, I mean, you've seen it with attrition rates and you've seen it with scale, with wage hikes. I was not very surprised when this enormous amount of margin pressure did come in. So I'm not too challenged on this sector in the medium term. In the short term, yes, we probably need to go through this cycle for the next 6 months to 9 months to see how we emerge on the other side.
Kenneth, good morning. You had flagged off that a lot of companies did make their way to the equity markets and there were a lot of recent listings, but they need to demonstrate longevity as well as profitability in order to sustain themselves and, of course, make returns for shareholders. Is there anything that you think that has, come through when it comes to the earnings cycle?
There's nothing that is. I mean, there are two components there. One is the old age company. One is the commodity businesses and businesses mapped into inflation. I think that we will see the highest profit growth that's coming through. And the new age businesses, I think they will go into a consolidatory mode for an extremely long period of time till they stabilize their balance sheets. And key to this is they have to stabilize their balance sheets because burning cash is not a business model. It's never been in the past. It's never going to be in the future. So they've got to stabilize their business model. They've got to earn their expenses and build a model from there. So there's going to be an enormous amount of consolidation and reasonably high mortality risk in that part of the world.
And I wonder where you stand as well when it comes to the entire consumption basket owing to the raw material price inflation. Given the fact that we are seeing this weighing down, how are you looking at the earnings of some of these companies for the many upcoming quarters?
So consumers have two challenges. One is consumer and consumer companies have two challenges. One is inflation is eating into their earnings. So obviously the propensity to spend is lower. And if the propensity to spend is lower, they're creating lower amount of demand or demand which is not growing. So then you hit a slight roadblock in terms of growth coming into into consumer stroke consumption segment. Second is inflation, and when you can't pass on the prices, or when there's I won't say no demand, but when there's moderate demand, you can't pass on the prices. So consumer companies will be faced by two challenges. One is static demand and higher cost, and margins will remain compressed for some period of time. So it goes in line. I mean, any business which is linked to the inflation cycle is going to do well. The consumer and consumption in an inflation cycle is not the best place to be in.
Kenneth, what is the right way to look at consumer companies? If one works with an assumption that inflation will have a base impact and some prices will not sustain, wouldn't it be a contra trade right now to buy into consumers? Because if oil prices come down, if commodity prices come down, some of these large companies would also benefit because of that.
So, in previous cycles, and I think you're coming out of one cycle right now, you've seen consumer companies do nothing for a decade. Okay, you go back from 2000 to 2009 and look at someone like Unilever's profit growth. Okay, it was next to nothing. And when I highlight this one business, I mean, look at all your consumer names that were there at that point in time. They all had come through a very a period of time where inflation was moderate to high towards the end of 2009, 10, 11. Okay, and margins were completely under pressure. All companies out there actually consolidated their books. My sense, we are going into a period like this. So when we go through these multiples, when you go through a cycle like this, I wouldn't want to go bottom fishing at this point in time, because structurally that industry hasn't changed. There are more participants in the industry. Everyone wants market share. The ability to price a product is not there. So you will get bouts of corrections in these companies. You'll be tempted to go to allocate capital to that, but I would refrain at least on the medium-term basis. So that's one way of looking at it. And when I talk about a consumer business, it's not different from a materials business. For the last 12, 13 years, material companies did nothing after that huge spike in 2008, 9. So when you're allocating, when a lot of investors are allocating to that part of the market, always remember that both these, there's nothing cyclical or structural. Even a consumer business can go through a cyclical phase. And I think we are in that that period of time today, and you will normalize demand. Demand will normalize to go slow, and margin pressures will be quite consistent over the decade. Plus, competitive intensity will be high. So I refrain from bottom picking. You would probably have most of these guys will go into a trading zone, but I have seen them correct sideways for non length of time.
So Kenneth, the market is rotating. You got a good old ITC. Finally, it brings smiles on everybody's face when I say ITC is outperforming. BDI is making a comeback. PSU banks made a comeback last week. Commodity stocks made a comeback post-COVID. Are markets rotating? Is it time to kiss goodbye to, let's say, high P multiple, high ROE stocks and look at so-called value stocks which will benefit because of cyclical upturn?
So again, this is the nature of the market in as long as I have seen it. I mean, I'd pay 35 times earnings for a business. Why 35 times? Because it's a 3% earnings yield or cash flow yield, whichever way you would put it, right? And that's equivalent to what the bank accounts give me post-tax. Anything over that, I think it's a little difficult for me to digest, and that is our investment style. Okay. So for longer term periods, buying the right price has always worked out. And that's an investment style. So if you ask me, at all periods of time, you will get businesses that are in that zone. So we're not really going to shift our style to buy high PE companies. And when you say that is there a time to shift downwards, I think 2007, 8, 9, 10, the high PEs were in a very different industry. It was in infrastructure, real estate, commodities. And look what happened to them towards 18, 19, 20. Today, those high Ps are in the FMCGs, consumer names, some of the digital companies that are there, and the private sector, which are consumer-driven banks. And that rotation will definitely happen, and that realignment will happen, which is what we've been highlighting. There's a leadership change in the marketplace, and we would need to anticipate it because finally you will. I mean, as investors, you will participate in that in that part of the market.
So as you participate in that aspect of the market, Kenneth, and as you have been saying, you're going to give a cash to premium. It's not just new age companies. What about, let's say, power companies which are experimenting with renewables, are looking at expanding on that, or the auto sector where we're talking about EVs, whether it's bikes or even four-wheelers. Then how to play with that when you're going to have such a large R&D spend and stay with the times, the digital times?
So new age businesses, I mean, one is what the market does and what we do. We would like to see a business stabilize and grow. When you look at EVs, obviously there's a marketplace and there's a huge marketplace. But what technology is going to come in at the other end, we have no idea and we have no clue. Okay, nor are we competed to understand what would be the new technology that will drive markets. One thing I can tell you, EVs don't make money. And we will refrain from allocating money either on the EV space or in businesses that have legacy engines that run it, because technology is disrupting that marketplace there. So then, if I had to allocate money into any part of the marketplace, it will have to be the lenders. Okay, because the lenders take the risk on the change in technology. The lenders take the risk on, or they have better assessment of how that marketplace would evolve, and probably the biggest part of the entire profitability mix will lie with the lenders in that part of the market. So you'll have to pull out parts of the value chain that are profitable and allocate money to it all. The same thing goes for power plants on the renewable side. It's a fixed income market. It's not. It is definitely not something that an equity participant would go into. Okay, because the liability side is always leverage, or the funding side is always leverage. So that's not a place that we would actively play at. Obviously, one company could create enormous amount of money, and you've seen that across the world. But that's too low a probability for us to assess at this point in time in the Indian subcontinent.
You have been, overweight on select metal companies, and materials have, of course, been the top pick amid rising inflation. But just to stay with metals, which has had the jury divided with what we are now seeing, prices the way they moved up before the Russian-Ukraine war and the way they are now. Still legs to this rally, still room for this party? Are we still in the middle of a super cycle?
So I just leave you with a couple of either there's going to be demand or there's going to be or demand is going to plateau and fall off. Those are the only two things we need to choose from, right? Now you look at the Indian fiscal the Indian budget that went through, and we all called it a growth budget. It was the government which is allocating a higher amount of spend to infrastructure. Okay, you go back to the US and you look at Europe and you look at the Far East and you look at any part of the world, all of them are doing exactly the same. They're allocating more amount of money to bring the supply chains home or build out infrastructure. Now, all of these economies and the governments are doing this in a cycle where the supply chains are broken. Okay, so this is inflationary. When you have supply chains broken, effectively material is not available or material is available at a cost. So either you buy it or you set up your own capacity. Everyone's going to set up their own capacity. To set up your own capacity, you need incremental amount of material. So that's the ideation flow that I think we need to follow. So it builds on to the same thing. Inflation does create capital and does create a deleveraging cycle. It happens for the governments. Okay, the governments are going to have reasonable amount of cash to spend. When they put money into work, okay, and you've seen it in 2000 to 2008 when the Chinese did it, then the Indians did it. Okay, when you put that money into work, you demand more materials, and that creates a fairly tight demand and supply, because this time 23% of the world GDP, which is the US, 24% of the world GDP is talking about bringing the entire supply chain home. Now that's going to be, there's not so much of material that's lying around that the US can use to rebuild its infrastructure or to rebuild its supply chain. So my sense is, and this is how we structure it, is the marketplace will continue to have nominal to high inflation for a fairly long period of time. And you would necessarily have to move your portfolio to address the biggest spender of them all, which is the government balance sheets. Okay, so I'm on the other side, which says that metal or material prices will continue to remain elevated. They will be controlled, of course, by the central bankers' policies, but I wouldn't expect them to come off. The market will still be in a supply deficit.
Interacting with you. Many thanks for joining in and sharing with us your market outlook.
Thank you very much.
1.5%